Welcome to the Market Minute Weekly Brief, your Saturday catch-up on the week that mattered for investors. This was a big one. Wall Street wrapped up its strongest quarter in 5 years, then walked straight into a jobs report that nobody liked. We've got records, a hiring slowdown, a warning sign flashing under the surface, and a deal frenzy that touched almost every corner of the market. One quick note before we start. This is a recap for context, not financial advice. Nothing here is a recommendation to buy or sell anything. Let's get into it. Let's start with the scoreboard, because the numbers are genuinely eye-popping. The second quarter closed on June 30th, and it was the best quarter for stocks since 2020. The Nasdaq led the way, up 21.4% for the quarter. The S&P 500 gained 14.9%. Both had their best quarter since 2020. The Dow rose almost 13%, its best since 2022. And this wasn't just a quarter-end story. During the week, the Dow crossed 52,000 for the first time ever, then kept printing new records, closing above 52,900 on Thursday. That June 30th close was the 18th record of the year. So what drove it? On paper, there was plenty to be nervous about. The largest oil shock in history earlier in the year, worries about whether the AI boom can last, and a Federal Reserve leaning toward higher rates, not lower. The market climbed anyway. The engine was the high-flying chip stocks, the biggest AI winners of the moment, plus confidence that big U.S. companies keep churning out higher profits. One strategist at Stifel even lifted his S&P 500 target to 7,800. The takeaway is that leadership is narrow. A handful of chip and AI names are doing the heavy lifting, and that theme comes back to bite us later in this episode. Now the report that stole the spotlight to end the week. June jobs. The U.S. economy added just 57,000 jobs last month, when economists were looking for 115,000. That's a big miss, roughly half of what was expected. It's a sharp cool down from the spring. Over the first half of this year, the economy averaged about 92,000 jobs a month, and this print came in well below that pace. Here's the part that needs a footnote. The unemployment rate actually ticked down to 4.2%, but that's not the good news it sounds like. It fell because more people left the labor force entirely. The participation rate, the share of people working or looking for work, edged down to 61.5%, the lowest since March 2021. A shrinking workforce is flattering the headline number while hiring momentum fades. What does that mean for the Fed? This is the twist for 2026. This Fed, under Chair Kevin Warsh, is running hawkish, biased toward hikes to fight inflation. Before the report, futures markets put the odds of a July rate hike at about 1 in 3. After the week jobs number, those odds dropped to about 1 in 5. You saw that split in the tape. Weak jobs data knocked down the AI giants, but sparked gains in healthcare and other sectors that had been left behind during the chip surge. The Dow hit a record while the Nasdaq fell. Now for the part of the week that should make everyone slow down. Underneath the records, there's a leverage story building. Investors have never been more eager to juice their returns with borrowed money. Margin debt, what investors borrow from their brokers to buy securities, hit a record $1.4 trillion in May. That's up 54% from a year earlier, according to FINRA. On top of that, high-risk leveraged ETFs, the ones that aim to double or triple the daily move of a stock, are growing rapidly along with options trading tied to them. When markets are calm, that amplifies gains. When they turn, it amplifies the pain. And we got a preview of that risk overseas. In South Korea, a market dominated by high-flying semiconductor stocks and full of leveraged investors, stocks gyrated hard enough to trip circuit breakers, the automatic halts designed to stop losses on the way down. That sour mood briefly spilled into U.S. AI names. The honest takeaway isn't to panic, it's to know what you own. Record margin debt doesn't tell you when the music stops, but it does tell you the room is more crowded and more fragile than the calm surface suggests. Let's shift to the deal table, because this was one of the busiest weeks for corporate activity in a while. The headliner, Comcast is splitting itself in two. Comcast is separating its media business from its connectivity business, spinning off NBC, Universal, and Sky into a standalone media company. It's unwinding the old bet that combining entertainment and distribution was better together. And analysts already see it as the next deal magnet in an industry primed for more consolidation. In groceries, Kroger agreed to buy Giant Eagle, the food and pharmacy chain, for $1.65 billion. In building materials, Martin Marietta struck a $13.5 billion deal, including debt, to combine with limestone supplier Lois North America. And Carlisle made more than one unsolicited offer for roofing maker Owens Corning in what would be a well over $10 billion deal. Telecom joined in too. Verizon and Britain's BT Group are merging their international operations so each can focus on its home market. And in space, Rocket Lab agreed to buy Iridium, gaining a satellite fleet to compete with SpaceX. The through line for investors: this much deal-making at once usually reflects cheap confidence in available financing. It's a vote that management teams feel good about the environment, though it also tends to cluster near market peaks. Now to the theme really driving this market: AI and chips. The big story is that the gap between the US and China just narrowed. Security researchers said a new model from China's ZPU AI matched the performance of one of Anthropic's most powerful models in some cybersecurity scenarios, specifically finding bugs in software. And crucially, the Chinese model is open weight, meaning anyone can download and run it. That's a big deal for the tech race and for policy. It pressures the White House on its AI strategy, and it means companies like Microsoft are weighing how to offer Chinese models on their platforms. On the hardware side, Samsung and SK Hynix said they plan to invest more than $500 billion in a new chip-making hub in South Korea, an enormous bet on continued demand for the silicon behind AI. On individual names, it was a split screen. Tesla said its sales jumped nearly 25% in the second quarter, a real rebound after months of slowing sales. Nike, on the other hand, posted another sales decline, still struggling with weakness in China. And remember that narrow leadership? On Thursday, a pullback in chip makers alone was enough to drag the Nasdaq down about 0.7%, even as the Dow held near a record. That's the risk of a market leaning on so few shoulders. Let's close the news with policy and regulation, which had real market stakes this week. Start with the Fed, because independence matters to every asset you own. The Supreme Court, in a 5-4 decision, blocked an attempt to fire Federal Reserve Governor Lisa Cook, reaffirming the central bank's long-standing insulation from political pressure. Markets care a lot about a Fed that sets rates on the economy, not on politics. But in a separate 6-3 ruling, the court expanded presidential power over other independent agencies, like the FTC. So the Fed was carved out as special, while the broader regulatory landscape got more political. On trade, the U.S. declined to renew the USMCA pact with Mexico and Canada in its current form. Instead of a clean extension, we're heading into a decade of annual reviews. For any business that moves goods across those borders, that's a long cloud of uncertainty. Big tech kept getting squeezed abroad. A Swedish court ordered Google to pay Klarna nearly $2 billion in an antitrust case, and Google separately lost its appeal of a $4.69 billion EU fine over Android. And on crypto, a cautionary tale. Disclosures showed the president earned more than $1 billion from crypto ventures last year, while many retail buyers who followed him in at high prices were left holding the bag as those tokens crashed. Meanwhile, Binance was denied a license to operate in the EU over financial crime concerns. The investor lesson is old but timeless. When insiders are cashing in on the assets they created, the people buying late are usually the exit liquidity. So to wrap the week, records set, the best quarter since 2020, but a jobs report signaling the labor market is cooling and leverage quietly building under the surface. Watch 3 things from here. 1, whether chip leadership can keep holding the whole market up. 2, the Fed, with July rate hike odds now around 1 in 5 after that jobs miss. And 3, more deals, because that pipeline looks full. As always, this was a recap to help you think, not financial advice. Do your own research and size your risk for your own situation. If this helped you make sense of the week, subscribe to Market Minute for the daily briefs and next Saturday's weekly brief.